Hello and welcome to today's extensive weekend video, which is called Non-Farm Payrolls. Let's reflect upon this, what they did to stocks, gold, and of course US dollar with yields, because these are pretty important turning points for markets ahead. So let's examine their longevity. Such is the daily chart of S&P 500. We can see that Wednesday's poor employment change had been not confirmed by the data. However, there are cracks under the surface that the market and the economy have decided, for the time being correctly so, to disregard. I will talk these as well. However, the technical picture is clear that we are headed in a certain direction, and non-farm payrolls provided a good impetus. As well, this bears an important influence upon the relative performance of those three individual sectors, as you will see further on. But let's stick with macroeconomics for a while and pick up most briefly the key factors. We see that hourly earnings are not declining. The headline figure had been quite good. Manufacturing is not really surging forward at all. Government payrolls flattish, basically from 1,000 to minus 1,000, that's peanuts. And private payrolls were those that have delivered the headline figure. However, if you dive under the surface, you see that part-time jobs, and not exactly jobs requiring highest qualifications, had been the drivers. These are not healthy signs, and especially if you look at the participation rate, which dipped lower by 0.2%, which is reasonably a lot on a monthly basis. So this is masking quite some strain under the surface. So looking down at the consumer credit change, we see rising credit balances. That's another sign of the consumer being under stress. Have a look as well at used car prices. These had not been going up by nearly as much as before, as both the month-on-month picture and year-on-year picture reveal. This means more than lingering uncertainty over the tariff impact, and more when it comes to the real economy. So even though we are not in a recession, even though there is no worldwide or nationwide calamity, no war that the US would be directly involved in, a declared war, nothing like that, we see that the role of deficit spending is high. Thus far, the bond market does not reveal bond vigilantes waking up and reining in government spending. On the contrary, we see the big beautiful bill, which is for economic and political reasons being pushed to get passed before the month of June is over and recess takes over, which would delay the passing of the bill, which is a lot of deficit spending forward. And you know, midterms are approaching, and this is the window of opportunity when basically all the legislature and presidency is being controlled by one party. However, you see that the economy is not surging ahead. However, the growth rates, they are healthy. They are to be running at well over 3.5 GDP growth. These are excellent figures, so you might as well be correctly asking why such a great deficit financing need, and how much would the deficit be if we were actually in a recession. So much for diving into these economic data and what it means for the real economy. The key takeaway is that for all the tariff uncertainty, all the hits, and all the waning, weakening, lagging soft data being gradually translated into hard data, the translation mechanism is not there yet, because non-farm payrolls have revealed that the economy is actually stronger under the surface, with all the cracks that I have already mentioned, such as rising, trending higher, continuing claims, initial claims going above 250,000 in basically no time going forward. Such is my assumption, but immediate recession is not on the table. And with the Baker Hughes data, you can see just what kind of a pressure the US shale is under with these reasonably low prices. That's what I'm diving into in trading signals, where I'm covering not just gold, silver, oil and copper, but based on your requests, somewhat more. Thank you for liking these videos and subscribing to the channel. Your likes and shares help greatly, so thanks again. Here we go with the 15-minute chart, and based on the actual real economy not being in as bad a status as feared, we see that S&P 500 immediately jumped, surged higher, retraced part of it and closed on a reasonably cautious note. That also, of course, ties well into budding Nasdaq failure to keep the outperformance of prior days, where I had been covering that in the intraday channel a lot, and it of course necessitated a change in outlook, where I had seen, based on the data, that the good non-farm payrolls would lead to broadening of market breadth. And actually, if you look at the following chart and compare it to the preceding one of S&P 500, this chart, that's Russell 2000, you see that the small caps had been the daily winner. After being so badly beaten down on all the tariffs and liberation and everything, they are starting, and it's perfectly visible if you compare the Friday performance or second half of this week, to be more precise even, you can see that Russell 2000 is springing back to life, and unlike the prior two indices, it had seen a buying influx before the closing bell, which tells a message for short-term traders in itself. And that's a reasonable learning that we can take advantage in our swing trading as well, because in the say opening months of new Trump presidency, it makes greatest sense to be nimble, no matter how much the tariff wars had died down. But this is arguably the key chart. If I had to pick one, which would be the dog wagging so many other tails, and it is the yields one. Basically, good non-farm payrolls means that the Fed has very little incentive to do anything, so expect one more carbon copy statement on the next Fed meeting with no rate cuts, and this means that yields have shaken off. The prior red candle, the long one, had been Wednesday's ADP employment change, coming in historically very, very low on the last couple of years basis, and we see that completely reversed and circling back to the big beautiful bill that is being worked on at getting passed. We see that the yields are not yet revolting, but the period of decline is over, and that means that the equity risk premium, which I have been talking at the most opportune times over the prior months, is sending a certain message which would come back to haunt stocks. Let's leave it at this, because that's a medium-term perspective, and I will be, of course, covering it in great detail with clients who ever approach me with their individual questions, because that's what it's standing on for them if they wish to tailor it to their own individual needs. Here we go with the US dollar, where you can see that it had not nearly enough enthusiastically corresponded to the rise in yields. So there is still some kind of a lingering pressure on the US dollar, no matter how well it is holding around the 99 line. It of course needs certain catalysts too, and the budget uncertainty, budget plans, and debt rollover situation is keeping the sentiment in check. So that's weighing down on this chart, and that's how it must be read, no matter how well in the short run this is keeping around the 99 level. The daily perspective of stocks, we can see that tech had not been outperforming Friday on a daily basis, and it was only financials that did their job, and frankly industrials could have been a bit stronger. And given that Tesla is within consumer discretionary, the daily result is not bad, but take it into account when looking at this 5-day perspective of XLY. And XLP, yeah, I'm sure you have not missed P&G cutting approximately 15% of its office force, starting to favor more the small teams. That's as well one of the many signs of the times. Yet the clear division between XLY and XLP is there, and tech outperformance is in, and this is about semiconductors, not just any, but AI ones. These are the drivers. No matter the great run-up of AVGO into earnings and then stabilizing and working off its really overbought situation, it doesn't mean that AVGO is going to collapse. It can just go sideways, digest it. It's more important to me that Nvidia is holding the deep sea level and just knocking on the door higher, even if it does not go anywhere. The truly volatile stock these days, for all the for all the very public bickering is Tesla. So there is the greatest amount of volatility, forward-looking one, that we as traders can take advantage of. Does Tesla's Friday scandal look convincing to you? So the very bottom after a slide, or can the sellers just return? Yeah. So, and another trading signals preview. I have already talked a bit about oil, where, as you know, as the saying goes, the cure for low prices is low prices. We have seen, and I have commented upon the Baker Hughes count, and that means that oil is on a certain path. So is copper, so are commodities, so is the dollar. Yet, how to make sense of this gold decline? I have been telling to trading signals clients Friday that gold would have a hard time defending its prior gains, and those gains be concentrated on a daily basis in high beta names, high beta plays, which in this precious metals complex is undeniably silver. I'm not talking so much about junior miners being the most leveraged play versus compared to GDXs. So it's more the quicksilverish silver nature that is capturing the high beta theme within precious metals, and you can see how silver delivered smartly on that move, and it's on the move. And I had been very vocal behind the scenes, because all the care goes primarily to premium clients, and that's been the gold-silver ratio that is having pretty good prospects of starting to swing more in silver's way. And you can see how well it had been doing, and all eyes again on yields and US dollar. Thank you for liking these videos and subscribing to the channel. As you can see, this is all pretty linked, and I'm keeping those weekday ones very short for the time being, and concentrating on individual questions so as to serve clients way better than is apparent from the public view, whether it's Twitter or YouTube. My joint page will help you select what's right for you based on what and how you trade. Daily analytics plus intraday channels, greatest punch, no contest.